Welcome to TalkTickers, your shortcut to understanding what's really driving the market movers.
Today, we're diving into BOK Financial Corporation, specifically their first quarter 2025 earnings call.
Yeah, we'll pull out the key bits, analyze the performance, and try to figure out what it all means going forward.
Okay, so headline numbers. BOK reported earnings of $119.8 million. That works out to 1.86 cents per diluted share for Q1.
Pretty solid start then.
Seems like it. They really emphasized their capital position. TCE, tangible common equity, hit 9.5%, and CET1 was strong at 13.3%.
And liquidity, always key for a bank.
Definitely. They flagged it as strong, pointing to a loan-to-deposit ratio of 62%, so plenty of funding cushion there.
Okay. What about the other side, credit quality? Any red flags?
Not really. They said credit quality remains solid. Criticized and classified loans were low. Their total allowance for credit losses is sitting at 1.4% of outstanding loans.
Okay.
And net interest income was strong. Actually, the net interest margin, or NIM, expanded. That's the third quarter in a row it's gone up.
That's a positive trend.
It is. But fee income took a bit of a hit. Dropped compared to last quarter.
Oh, where did that come from?
Mostly the trading business, it seems. They blame market volatility. But interestingly, some of that was kind of offset because the net interest income related to trading actually went up.
Ah, okay. A shift in how the revenue showed up.
Exactly. Now, the one area that looked challenging was loan growth. The overall portfolio actually shrank a bit in Q1.
Shrank. Why?
Primarily driven by a pullback in the energy sector lending. If you strip out energy, they said the rest of the loan book was, relatively stable.
Okay, so a bit of a mixed picture then. Strong capital, solid credit, decent NII growth, but fee income wobble and a loan growth challenge, especially in energy.
That sums it up pretty well.
Right, let's dig into that loan portfolio a bit more.
Yeah.
That energy loan contraction, 12.1% down in one quarter.
Yeah.
They're saying it's payoffs from industry consolidation.
Yeah, M&A activity leading to loans getting paid off.
But they also say their appetite for new energy deals hasn't changed, and they expect balances to rebound. Does that track? Or are they maybe getting a little cautious on energy?
Well, it's a fair question. They say the appetite is there, but, seeing that kind of pullback, you have to wonder if there's a subtle shift. We'll need to watch the next few quarters.
Right.
But the flip side is the core C&I portfolio, commercial and industrial loans, that was stable. Actually, it grew 4.2% in the quarter. So the underlying business lending looks okay.
Diversification helping maybe?
Could be. It suggests they aren't just reliant on energy swings.
Okay. Then there's healthcare, loans down to 4.5% linked quarter, even though they apparently had record commitments. What's going on there?
Payoffs. Again, they mention asset sales and companies refinancing into non-bank options, private credit and the like.
Ah, so competition from outside the traditional banking system.
Exactly. They do expect that payoff activity to slow down, though. We'll see.
Right. A brighter spot was commercial real estate, CRE, up 2.1%. Mostly multifamily and industrial from loans made last year funding up.
Yeah, the sectors have been more resilient generally. The growth is kind of baked in from those 2024 originations. They seem pretty confident about more growth later this year, too.
A confidence based on what? Just those sectors being strong?
Likely that, plus their existing pipeline. Though, the broader economy is always a bit of a wild card for CRE.
Always is. Now, this new venture, mortgage finance and warehouse lending, launching around September, October, targeting indie mortgage originators.
Yeah, over 500 of them, apparently.
In this rate environment. And it's a packed market. What's their angle, do you think?
That's the million-dollar question, isn't it? They must see some kind of synergy or gap. Maybe better service, leveraging existing tech or relationships. Hard to say yet.
Definitely one to watch. Okay, quick detour back to credit quality. Non-performing assets, NPAs, ticked up a bit.
They did, yeah. But coming off historically really low levels, so the increase itself isn't huge yet.
And charge-offs?
Minimal. Only $1.1 million for the quarter. Over the last year, they averaged just 4 basis points. Very low. They expect that to continue.
And the allowance, 1.4%, seems decent. So overall credit still looks okay, despite the small NPA uptick.
Yeah, appears well managed for now. The allowance seems robust enough.
Good. Let's pivot to that fee income drop.
Yeah.
Trading revenue down significantly. You mentioned market uncertainty, lower MBS volumes, tighter spreads.
Right. But then there was that $10.6 million shift from trading fees to net interest income. Explain that dynamic again.
Sure. So when the yield curve gets steeper, meaning longer-term rates are higher relative to short-term rates, their trading desk can sometimes make more money on the spread itself.
Funding positions cheaply short-term and earning more on longer-term assets they hold for trading.
Basically, yeah. So even if trading volume is down, the profitability of the positions they do hold can show up as higher net interest income instead of just trading fees. It's sort of a revenue mix shift within the trading P&L.
Got it. So looking at total trading revenue fees plus NII might give a clearer picture.
Probably. And interestingly, while trading fees were down, mortgage banking revenue was actually up by $1.7 million.
Yeah, they said that was driven by higher mortgage production volume in the quarter.
Yeah.
So some bright spots in fees, too.
What about asset management and transaction banking?
Pretty steady, apparently. Brought in $133.2 million. Assets under management, AUMA, did dip slightly, though, about $659 million, reflecting the choppy markets.
Makes sense. Okay, let's look forward. Their guidance for the full year 2025. What are they telling us?
Well, for loan balances, they expect growth driven by those construction loans funding up, growth in core C&I, and the successful launch of that new mortgage finance business.
But they flagged economic policy uncertainty as a risk.
They did. On net interest income, guidance is unchanged, assuming 2 25 basis point rate cuts later this year.
Assuming? Big assumption these days.
Tell me about it. They did say more cuts could provide a small upside, and that trading NII versus fee split will depend on rates and the curve shape.
And on overall fees and commissions.
They widened the guidance range. Again, citing economic and market uncertainty, especially for fixed income trading. Seems prudent.
So the takeaway on guidance is cautious optimism. Growth levers identified, but aware of macro risks.
Yeah, that feels about right. They also expect charge-offs to stay low.
Okay. Anything interesting from the Q&A session?
A few things. They doubled down on expecting a trading rebound in Q2, saying April trends looked positive.
This benefit holds.
And those pressures on energy and healthcare loans, they don't expect them to continue at the same pace as the last couple of quarters, again, citing positive signs in April.
And loan pipelines generally.
Called them good and strong.
Yeah.
But the caveat was borrower uncertainty about actually closing deals given the economic backdrop.
The commitment versus closing gap.
Yeah.
Classic uncertainty sign.
Exactly. They also mentioned they don't think they'll need to build their allowance for credit losses ACL ratio higher this year.
That's confident.
It is. Oh, and that deposit beta point was interesting. They hit a 75% beta in Q1.
Meaning their deposit costs went up about 75%, as much as the Fed raised rates.
Roughly, yeah. For their interest-bearing deposits, their cumulative beta for the whole cycle is 74%. They seem happy with that and think they can manage deposit pricing going forward, even if the Fed doesn't cut rates.
That strong loan-to-deposit ratio probably gives them flexibility there.
For sure. They aren't desperate for deposits. They expect some growth, but they don't have to chase it aggressively.
Anything else jump out?
They talked a bit about energy, saying today's environment is very different from the 2014 downturn. Lower leverage, better hedging by clients. Stress tests apparently look okay, even with lower oil prices.
Okay, good context. And share buybacks.
Yes, big point. Given their strong capital and the fact the stock price pulled back recently, they expect to be active with share repurchases in Q2.
Right. Signal of confidence, returning capital. Okay, fascinating stuff. That brings us nicely to our This Is Not Financial Advice segment.
Yeah.
You've got BOK Financial, strong capital, buybacks coming, expecting a trading rebound. What's an outrageous but plausible trade idea here?
All right, let's brainstorm. So you like the buyback story, the potential trading bounce back, capital solid. How about this? You go long the stock BKF, standard enough.
Okay.
But to juice it a bit, maybe add some, say, slightly out of the money calls, maybe 3 to 6 months out.
Yeah.
Betting on that positive sentiment kicking in from the buybacks and the Q2 trading recovery.
Buying calls adds leverage, but also risk if it doesn't pan out. What's the outrageous part?
Well, how about funding part of it or hedging the broader market risk by simultaneously shorting a long-duration treasury ETF, like TLT or similar?
Ooh, so long BKF. Long BKF calls short long-term treasuries. What's the thinking there?
The thinking is, you capture the company-specific upside with the stock and calls. But if broader rates stay higher for longer, or even tick up because the economy is actually okay, that short Treasury position could potentially offset some risk or even add alpha. It's a play against the consensus rate cuts are definitely coming soon view while still being long the bank.
Huh. That's definitely got a few moving parts. Betting on the bank specifically, but also making a macro call on rates via the Treasury short. Spicy.
Exactly. Capitalizes on their story but acknowledges the uncertain rate path. Of course, massive disclaimer, this is purely hypothetical, just a thought experiment, not advice. Do your own homework, seriously. Lots of risk in a trade like that.
Absolutely. Definitely not advice, but a creative angle.
Yeah.
Okay, that wraps our deep dive into PAC Financial's Q1 call. We've hit the highlights, dug into the segments, and even cooked up a potential trade scenario.
Remember, this is all just for informational and educational purposes. We're breaking down the call, not telling you what to do with your money.
Couldn't have said it better. Always do your own research before making any investment decisions. What are your takeaways on PAC Financial? Let us know what you think.
Yeah, we'd be curious to hear your perspectives.
Thanks for tuning in to TalkTickers.